Good afternoon, everyone. My name is Amira Azhar, and I'm partner in the Tax SST and Customs practice at RDS Partnership in Malaysia. I specialize in tax litigation and advisory, and I'm delighted to be moderating today's webinar. On behalf of Law Asia's Taxation and Customs Committee, I'd like to welcome you to today's webinar on recent tax considerations and cross-border corporate transactions. Cross-border transactions are more frequent than ever now, and with that comes increasingly complexity in tax rules, compliance, and also enforcement. Today, we'll hear insights from experts from South Korea, Singapore, and China on latest developments and challenges around international tax regulations, OECD Pillar 2 implementations. We're also talking about TP implications, withholding tax developments, and also other emerging issues affecting multinationals. So each panelist today will present for around 10 to 15 minutes. We'll then move into a Q&A and discussion. So please feel free to drop your questions in the chat as we go along. I'll also introduce our panelists today. So our first panelist today is Ms. Ellie Jin, partner and foreign attorney at Yochon LLC in South Korea. Ellie advises multinational companies on a wide range of international tax matters with deep expertise in tax controversy and also cross-border structuring. Before joining Yochon, she worked with PwC Australia and also Dixon Advisory in Australia. She has co-authored several publications on Korean tax developments and also frequently writes on emerging trends in international taxation. And our second panelist today is Mr. Justin Fu, tax lawyer at Deheng Law Offices in China. Justin brings over 20 years of experience in tax practice, having previously served as a tax partner and office tax leader at KPMG and also Grant Thornton with professional experience in Germany and also Italy. His international background allows him to advise multinational clients with a truly global perspective. At Deheng, Justin integrates his financial and tax expertise into legal services, providing clients with comprehensive and also practical solutions. And our third and final panelist is Mr. Vigna Raja, Head of Tax and Private Client Departments at Rajatan Singapore LLP. He also co-heads the South Asia desk. Vigna specializes in complex tax matters across income tax, GST, stamp duty, property tax, and also tax treaties. He has an outstanding track record in high-value disputes with the IRS of Singapore. He is frequently instructed by multinational corporations, leading law firms, and also Big Four accounting firms. Beyond tax, he is also regarded in trust and private wealth, having advised on the establishment of nearly 100 family offices in Singapore. He is consistently ranked as a leading tax and private wealth in Asia. So we're very fortunate today to have such an accomplished panel. And so let's move on to presentations. Each speaker will have 10 minutes, about 10 to 15 minutes to share their perspective. And today, can we start with Ellie?
Okay, good afternoon, everyone, and thank you for joining us today. Let me just share the slides that I've prepared. Can everyone see? Okay. So as Amira just introduced, I am a partner and a foreign attorney in the international tax team at Yochon, a Korean law firm. And as part of the international tax team, I provide tax advice to many foreign companies that have investments or presence operations in Korea, or Korean companies that want to expand and invest overseas. And as everyone knows, cross-border corporate transactions give rise to various different tax issues. But today I sort of want to focus on two topics that are becoming increasingly common in practice. The first is corporate migration or domestication, and the second is indirect share transfer. So let's start with corporate migration. Corporate migration is becoming increasingly common among multinational companies, and we are seeing more and more clients asking whether moving a foreign company to a different jurisdiction can actually trigger tax implications in Korea if that foreign company has a subsidiary in Korea or holds shares in a Korean company. And motivations for corporate migration can vary. I think it could be a strategic reason, financial or operational reason. But in practice, so far, a major driver seems to be to simplify group structures. So many corporate groups want to eliminate unnecessary layers of holding companies and simplify their holding structure. And the key objective here seems to be making it easier for the lower tier entities to distribute earnings up to the very ultimate parent. So corporate migration often forms part of a broader group restructuring project. And the diagram here, structure diagram here, shows a typical example of corporate migration that we see. There are two Luxembourg holding companies interposed between the ultimate parent entity in the US, and there are subsidiaries in different jurisdictions, including Korea, under the Luxembourg holding company. To simplify this group holding structure, Luxco 1 would merge downstream into Luxco 2, and after the merger, Luxco 2 would domesticate to Delaware as a Delaware limited liability company, or it could convert into a Dutch company. And in cases like this, the key issue for Korea is whether Luxco 2's domestication to Delaware in the US triggers any Korean tax implications. Cross-border conversion of corporate nationality is not really a familiar concept in Korea. So Korea doesn't really allow any inward or outward corporate migration. And because Korean companies cannot relocate to a foreign country, and a foreign company cannot become a Korean company, the only tax issue in Korea regarding corporate migration is whether an offshore corporate migration of a foreign company that holds Korean subsidiary or Korean shares is a taxable event in Korea. So because Korea doesn't recognize corporate migration, Korean tax law remains silent and doesn't really have any explicit provision regarding the taxation of corporate migration. And until very recently, there were some tax tribunal decisions and the NTS, the tax authority in Korea, tax rulings. But these decisions and rulings only discussed corporate migration in the context of tax migration. So the relocation of a foreign company's place of effective management. And in these decisions and tax rulings, the tax tribunal and the NTS focused on three factors. So they looked at whether the relocation actually liquidates the existing company and create a new company, and whether there is a change in the substance of the foreign company, like the legal rights and obligations, legal personality, and ownership, and whether there's a reasonable business purpose for the relocation. And to the extent there was no, for example, the relocation doesn't liquidate the existing company and it doesn't create a new legal entity, and the other two factors are also not satisfied, then the tax tribunal and the NTS said the offshore relocation of a foreign company should not create a taxable event in Korea. So the foreign company holding the Korean subsidiary or Korean shares are not deemed to have disposed of and acquired the Korean subsidiary or shares for Korean tax purposes. And in July 2023, the Korean Tax Authority finally issued two tax rulings. that specifically relate to a foreign company's conversion of its country of incorporation. So the conversion of corporate nationality from one jurisdiction to another. There were two cases, and in one, the ruling applicant was a foreign company located in Labuan, Malaysia, and it had a wholly owned subsidiary in Korea. The Malaysian company transferred its country of corporate registration to Singapore, and the NTS responded to the applicant saying that the relocation shouldn't be viewed as resulting in a transfer of the Korean subsidiary, because the relocation doesn't liquidate the company, the foreign company in Malaysia, and create a new company in Singapore, and there's no change in the substance of the Malaysian company and the legal rights and obligations of that company. So the NTS actually looked at the same three factors the tax tribunal looked at in the tax migration cases. The second case actually involved a company that was located in Jersey, which relocated to Singapore, and the NTS also looked at the same three factors in determining whether there was a taxable event in Korea. So there's definitely still a risk of recharacterization by the NTS for Korean tax purposes if there are not proper documentation in place to substantiate that the cross-border conversion took place with full corporate continuance. Then the tax authority in Korea could attempt to recharacterize the offshore migration as a taxable event in Korea. So it's important to have internal documentation in place to prove that the foreign entity remained the same entity and there was no dissolution of the pre-migration entity and under the laws of all of the relevant jurisdictions. The second topic that I wanted to talk about was offshore indirect share transfer. And the diagram again shows a typical structure of an offshore indirect transfer. There are two foreign companies, and at the very under foreign company 2, there's a Korean subsidiary, and the parent entity of foreign company 2 is another foreign company. So foreign company 1 would sell the shares in foreign company 2 a third party buyer. And this would constitute an indirect transfer of the shares in the Korean subsidiary. And the key issue here would be whether the indirect transfer can be deemed to be a direct transfer of the Korean subsidiary shares, which would give rise to a taxable event in Korea. And there will be capital gains tax implications, security transaction tax, and deemed acquisition tax implications if the transaction will be reconstructed as a direct transfer of the Korean subsidiary. And there are different views regarding the taxation of offshore indirect share transfer in Korea because the tax law for Korean sourced income derived by a foreign corporation to be taxable income in Korea, the tax law actually provides an exhaustive list of taxable Korean sourced income for foreign corporations, but capital gain recognized from an indirect transfer of Korean company shares is not included in that list. But the Korean tax authority still sometimes attempt to reconstruct the indirect transfer as a direct transfer of the Korean company shares based on the Korean substance over form principle. So basically, they would deem a foreign company 2 as a mere conduit and treat foreign company 1 as having sold the Korean subsidiary shares to the third party buyer directly. And one of the relevant points here is that the Supreme Court actually limits clearly the scope and application of the substance over form principle. So the Supreme Court in many cases held that the tax authority should respect the legal form of the transaction that taxpayers choose. And offshore transactions between two independent foreign entities cannot be arbitrarily deemed to be fictitious. Recently, there was a case where the NTS attempted to recharacterize an indirect share transfer as a direct transfer of Korean company shares. So in this case, a Singapore entity held shares in a BVI subsidiary, which in turn held shares in a Singapore subsidiary, which held shares in a Korean subsidiary. The Singapore entity sold the shares of BVI subsidiary to a third-party buyer in Hong Kong, and the Korean tax authority in this case reconstructed the share sale as a direct sale of the Korean subsidiary shares, and they issued tax assessments to the Singapore seller. And in December 2024, the Jeju District Court, which is the court of first instance, canceled the tax authority's tax assessment. And the court effectively said that if the tax authority is allowed to reconstruct this type of transaction as a direct sale of the Korean subsidiary, then the tax authority can effectively impose tax on any level of share transfers occurring within the sellers group. And this would ultimately significantly undermine legal certainty and cause serious threat to taxpayer predictability. The tax authority, I think, appealed to the district court, and the case is still pending. So we won't find that. We'll need to find out the results later on. But that was the holding by the administrative court. Okay, these are the two topics that I've prepared for today. And if there's any questions, we can discuss the questions at the Q&A during the Q&A time later on.
All right, thanks, Ali, for the presentation. Can I invite Justin to share now?
Sure. Thank you so much. Let me share my slides. Can you see it?
Yeah.
Okay, great. Thank you, everyone. I'm so honored to be here to share with you about this M&A tax issues. Actually, of course, I will focus on China tax issues. But as you know, China is a different jurisdiction. All the law taxation systems are totally different. Maybe you know that if we want to invest in China, unless you are a bank, you cannot set up a branch. You can only set up a separate company limited or something. For example, in China, we have foreign exchange control. So you should pay much attention to the foreign exchange things in China. And something maybe you don't know, in China, if we have tax dispute with the tax bureau, 99% of this case will not go to court. We just negotiate with the tax authorities. So everything is different. I don't think I can give you all the whole picture in 10 minutes, but today I will go through all these topics. They are basically very general topics, but I will share my experience here in China in these issues so that you can have some insights about if you want to do this M&A in China or work with the Chinese companies. And later in the Q&A session, you can have more questions, and then I can answer your questions about these things. First, as we know that the global M&A trends is changing. The deal value is up, but the volume is down. That means we are going to find some good cases to do the M&A in this case. And if we look at the background of the Chinese economy and the China-US relationship, I know that some of the investors maybe hesitate to go to China or work with a Chinese company, but we still see a lot of direct investment and M&A by the foreign companies in China. That means this large market is still very attractive to the foreigners, especially look at the surrounding countries like the Southeastern Asia countries, Korea, Japan. Those countries are still very interested in the Chinese market. So that's also the reason why we are doing this M&A taxation for the foreign investors in China. These 8 topics we're going to talk about today, but I cannot focus more in the details. So I will tell you my experience about this in China. The first thing is about goodwill. This concept is very popular all through the world, but in China, goodwill is not allowed in the tax law. So when you do any M&A cases with the Chinese company, especially a global M&A case, including a part of the Chinese subsidiaries or Chinese companies, you will think about goodwill. In China, goodwill is not deductible for tax purpose in China. So there will be some deferred tax or some tax loss in China. I encountered a lot of foreign investors talking about these topics in China. The answer is no, very simple answer, no, goodwill is not allowed in China as a tax factor. So this is quite important because if we are doing some global M&A case, goodwill is very popular, is everywhere, but in China, for tax purposes, it's not allowed. The second topic is about tax loss. Because if you are going to do an M&A case, the target company may be in tax loss in some cases. So during past decades, before the new Chinese tax law, a lot of foreign investors and as well as the domestic Chinese investors were trying to buy some tax loss companies to utilize the accumulated loss for the tax purpose. And the Chinese tax authority noticed this issue, and in current Chinese tax systems, tax loss can be utilized. Tax loss in the target company can be utilized somehow, but quite limited. So when we talk about these companies in China, if you want to do business with them, you have a lot of choices. But if you want to utilize the tax loss here in China, the tax authority will look at you, what you are going to do. So we have some plan for the things. Majorly, we just think about some of the loss can be utilized. So why I'm talking about this topic? Because in some new industry, some new energy, new technology companies in China, at the very beginning stage, they are in loss, but the future is promised. So the foreign investors want to invest in these companies, but they will face this tax loss problems. And sometimes there will be some disputes with the tax authority. And we have a lot of cases on this. So if you have this sense about tax laws in China, you may have to plan to invest in these new companies. This is the general rule of the loss utilization. And then transfer pricing issues. I noticed that some of the audience has raised the question of the transfer pricing. As I said, the tax law of China is so different, but the transfer pricing law in China is quite international. It's quite similar to foreign companies. So this part may be quite familiar to you if you understand the transfer pricing and all these related regulations in other countries. The principle in China is the same. The different thing here in China, as I said to you, is that you cannot go to court or go to a very high level authority to judge that for you. You need to always negotiate with the local tax bureau about the transfer pricing issues. When you invest in China with some local companies, especially in some faraway places, in Western China or in some second, third tier cities in China, the local tax officials may not have very comprehensive understanding of transfer pricing knowledge, but they know this concept. They want to, get some tax from you. Then they will come to you to talk about this topic, because in China, transfer pricing topics are very, highly depends on how you negotiate with the tax authority. So in this case, you may spend a lot of efforts, local communication with the in-charge tax authority to get a better result for you. So transfer pricing issue in China, I want to summarize it as this. This issue, transfer pricing issue, is not a very well-known thing for the tax authority. Some tax officials in faraway cities may not have comprehensive understanding of this, but they know this concept. So they may try to collect some tax from this concept. Secondly, if you encounter any TP issues in China, a good communication and negotiation with the tax authority is very important. Not only based on the law or tax regulations, but also try to understand their concern about the things. It seems like some business negotiation, not a tax law, but it's a fact in China, because when you use different methods to calculate the profits and like the risk, other things, it's always negotiable. It really depends on the method you choose and all the factor and information you provided. But finally, it really depends on the acceptance of the tax authority, because you cannot go to the court, you cannot go to the higher level, very high level authorities. So negotiation and friendly negotiating with the local company is quite important. Okay, I know what you are going to say, but say it's a fact. Okay, and the other topic, basically, it's a very essential topic for any company want to invest, who want to invest in a foreign country. That is the tax structure. Where is the holding structure? Where should you put the holding structure? Actually, if you want to invest in China, the good place to put investment holding structure, you have two choices. One is Hong Kong, the other one is Singapore. Those two choices are very popular. The reason is very apparent. Hong Kong is quite close to politically, and also physically it's close to China. So you can have your management, everything in Hong Kong. But I know a lot of companies also choose Singapore, because if you look at the tax treaties signed between China and foreign countries, Singapore is one of the favorable treaties of those signed by China. So that's the reason why a lot of foreign countries choose Singapore. Of course, when you invest in China, you may choose some second tier or third tier holding structures. Maybe you involve Cayman, BVI, other things. But the direct investor to a Chinese company are always Hong Kong company or Singaporean company. So if you want to have more understanding of this, I have a very long discussion with you, but you may understand that Singapore is a good choice. Hong Kong is a good choice. It really depends on how you can manage those holding structure. And also deferred tax considerations. Deferred tax considerations, if we think about this topic, we have two layers. The first layer is the company in China. In China, deferred tax is very, how to say, common, popular in all the Chinese companies. The one reason is that the Chinese law regulates a lot of tax adjustment to your expenses. So there are a lot of deferred tax assets for each of the company. But how to utilize it? It's the rule is quite complicated. And secondly, nowadays China is trying to encourage the R&D and new technologies. So there will be some incentive deduction or some preferable deduction for the things. So there will be some deferred tax liabilities for those companies. When you investment in this new industry, new technology companies in China, you will always face deferred tax issues. That's complicated because the Chinese Chinese tax authority are always very concerned about deferred tax issues, because that means you have some difference between the accounting things and tax things. So that means the Chinese company, when they do tax audits, they will always look at deferred tax issues. We have a lot of experience to deal with these cases, and not every cases ended in a good end. Okay. Yes. This is the deferred tax issues together. Okay. Other tax issues I'd like to say nowadays, the real estate industry in China is in the low point. But still, some of the related industry like the decoration, building decoration, and some other things are still very active in China. If you want to deal with these companies, you should look at the first in China. We always look at the political direction. Secondly, but we still look at the real estate taxes in China, because it used to be very heavy. But nowadays, because the industry is no point, maybe you can get some tax benefits on this industry. Okay, these are all the takeaways I just said about all the issues in China. As I said, I cannot give you a very comprehensive understanding of the things, but you may have some points, and later you can ask me questions. And after this, I want to list out some M&A opportunities in China. I want to say that biotech, IT, creation, all the new industries are very active in China. And the Chinese companies are very eager to cooperate with foreign investors, no matter how the investment is. It could be direct investor, there can be some authorization, they pay royalty, these things, a lot of things. But here I want to draw your attention to this one. Drone producers. In China, this is a very new and how to say very because the drone made in China may be banned in many countries, but those companies can help to provide components for foreign companies. For example, if you have a Malaysian drone company, they need some technology or components in China. The Chinese companies may want to cooperate with these companies. So this is a good area. If you want to have this opportunity, you can always find me. Okay, because I cannot finish all the things in just in 10 minutes, but I just list out the points. If you want more discussion with me, I'm always here. Okay. Thank you.
All right, thank you, Justin, for sharing. I've got questions to ask already in my mind, but let's hear from Vigna first. Over to you, Vigna.
Thank you very much. First of all, it's such a pleasure being here. Thank you to Amira and RDS for the invitation to be on this distinguished panel with Ali, who, of course, we work with very closely, and experts like Justin as well. So, perhaps what I'll do very quickly is to give you a little bit of sense as to what the tax authority is like in Singapore. So, I do the most number of tax disputes in recent years, led many of the landmark cases before our Supreme Court. But to give you a sense, in 2023, there were only two civil cases, civil tax cases between our Supreme Courts. And just like Justin previously mentioned, we very much the tax authority very much likes to resolve tax disputes, of course, always on a principle-based manner. And many occasions where they realize that the taxpayer's position is actually correct in law, the tax authority will back away. In fact, I would say over 90% of my cases get resolved fully in favor of the client. It's only those cases where there are really arguable points on both sides that you have to take it to court that it goes up. But one of the cases I did, Herbalife, which went up, IRAS lost that case, and it was in fact discussed in Parliament, and our Prime Minister had to address the question, why is the tax authority took on the case and lost? So I think with that sort of background, it's useful then to touch on the following 4 points. I'm going to go very, very quickly into some Pillar 2 developments in Singapore. We'll focus on investments, right? Refundable investment credits and how that plays a part when you're looking at investing in Singapore. I'll touch on a relatively new provision which taxes capital gains, and I think Justin mentioned that when you use the holding structures, whether it's Hong Kong or in Singapore, you have to be very careful how you manage. So this is relevant to that. And finally, I'll touch on very quickly on transfer pricing, particularly adjustments and how adjustments are calculated, because I see transfer pricing disputes as the largest number of disputes that I currently take on. And finally, I'll touch a little bit on Singapore's general anti-avoidance provisions, and tie in a little bit to what Ali previously mentioned on offshore transfers. So since essentially this year, 1st January, we have introduced income inclusion rule and a domestic top-up tax, right? So in line with the Pillar 2 recommendations. The key difference is that Singapore has not introduced under-tax profit rule, and that is not on the cards. Yeah. Now, Singapore has generally been known as a good place for investments, and perhaps one of the factors, in addition to strong rule of law, very good infrastructure, human capital, was competitive and favorable tax regimes. Of course, with the minimum rate of tax for companies which have 750 million euros in revenue, of course, falling under Pillar 2, what Singapore has come up with, which is consistent and is considered qualified refundable tax credit, are the refundable investment credits. So this, very importantly, can be offset against not just corporate income tax, but also domestic top-up tax. And if they're not utilized in the year, they can be carried forward. And if they're not utilized in a 4-year period, they're actually refunded in cash to the taxpayer. And essentially, it's relatively clear what refundable investment credits would be given for. So it must be for qualifying expenditure, which are listed here, and for qualifying activities, right? In relation to qualifying activities. So qualifying activities would mean investing in new sort of production capabilities, expanding the scope of activities in digital services, expanding R&D, expanding or establishing headquarters, and implementing solutions with decarbonization objectives, as well as setting up or expanding activities in relation to commodity trading. Right? The level of support, which means that if a taxpayer incurs a certain expenditure, they can get either 10%, 30%, or 50% of that expenditure covered in the form of refundable investment credits. So I'll take you very quickly, given the lack of time. For the 10% support level, you need at least 3 million in capital expenditure, and the taxpayer has to hire at least 8 employees. For 30% support, the capital expenditure has to be at least 5 million, and at least 10 employees have to be hired. And finally, for the 50% expenditure, we're looking at least a $7 million expenditure and no less than 18 employees. So again, relevant in terms of increasing investments into Singapore, we need to be well aware of these credits. Now, taxation of capital is actually really interesting because Singapore traditionally did not have capital gains tax, right? We only tax income that is, or rather gains that are income in nature. But from 1st January 2024, there was an introduction of Section 10L. And essentially what 10L does is that it taxes gains made by Singapore companies from foreign sourced income if the Singapore company does not have sufficient substance. So if it's just a shell company in Singapore, then that's an issue. Of course, if the Singapore entity has substance, it has employees, then it does not fall within the ambit of 10L. So this is specifically targeted at, I would say, shell companies, right, or SPV companies. Even then, it can be managed because the tax is only in relation to gains which are remitted into Singapore. So if the Singapore company does not remit it and declares a dividend, and the dividend is paid directly to the parent company, it doesn't fall within the ambit of 10L. But something to really keep an eye out, because I think a lot of our taxpayers and some of our clients were not aware of the introduction of 10L. So again, in summary, if you have adequate employees, substance, activities in Singapore, you're not covered. It doesn't fall within the ambit. And second, even if you don't have those activities, if the gains are not remitted or deemed remitted, you're not covered. Now, transfer pricing disputes, I would say, is the largest growing area of disputes in Singapore. And we've had interesting disputes involving, I would say, China, Korea as well. Yeah, and where we wanted to highlight were two things, right? The first is the surcharge if the transfer pricing is deemed to be not an arm's length is 5%, and it's not 5% on the increase in tax as a result of the transfer pricing sort of adjustment. It's actually 5% on the adjustment itself, so on the top line, right? So that's something to take note of. And what we see a lot of our clients doing is actually engaging in, if the sums are large, mutual assistance procedures. So actually there have been, Singapore has been very successful, I would say, in the Singapore Tax Authority has been very successful in pushing out mutual assistance procedures. There's statistics available. I didn't have time to go through all of them, but a decent percentage of cases are actually resolved within a 2-year period. So MAPs are, I would say, getting a lot more popular with the sums large enough. And of course, for certainty, advanced pricing agreements, and I think our very large clients actually favor this. And in some instances, it can take some time, but we find that depending on which is the tax authority on the other side we're dealing with, it can be a very, very viable option. In case of remission, I would say that IRAS, the Singapore Tax Authority, takes a very practical view. If it's a genuine mistake and you come forward, you can do a voluntary disclosure and get a waiver of penalties. But that is if no query has been levied against you previously in relation to that particular dispute. Now, finally, I'm going to touch on tax avoidance, right? And we have a general anti-avoidance provision, which is quite broadly drafted, right? Essentially, any arrangement which reduces or alters the rate of tax could be considered a tax avoidance arrangement unless you can prove that it was done for bona fide commercial purposes and did not have tax as one of the main tax reduction as one of the main purposes. So it's quite a broad sort of provision. But I would say the tax authority has been reasonable in its implementation, and if it can clearly be shown that the transaction was conducted in that manner for pure commercial purposes, or if there's a particular statute which provides for that treatment and you're taking advantage of a statutory provision for a reduced rate of tax, that's fine. So to draw back to the example that Ali very clearly spoke about, indirect transfers, right? So if you have a Singapore company and the shares of that Singapore company are effectively being transferred one or two layers above, say perhaps there's a Cayman entity holding the Singapore company, and it's the Cayman entity shares are being transferred, and the Cayman entity holds no other assets except shares of a Singapore company. Is that tax avoidance? Now, it doesn't give rise to capital gains because, as I said, generally we don't have a capital gains tax. So it's not a capital gains tax issue. It's more of a stamp duty issue. And Singapore imposes stamp duty at 0.2% of the fair market value of the shares being transferred. Now, the market practice is that it is seen as a legitimate transfer where you're transferring Singapore shares a couple of levels above. And the reason for that position is because if there has been legislation passed to deal with indirect transfers of Singapore shares in Singapore companies that hold primarily residential property. So for residential property, if you're transferring it a few levels above, there's statute which clearly deals with it. And no such statute was implemented to deal with any other situations. So the current market practice is that that does not constitute tax avoidance, but nevertheless, there's some, if you read section 33, there's still some underlying risk to it, but market has accepted it as acceptable risk. Of course, when you have any sort of circular or round tripping, that's an issue. If you have conduit entities involved in the structure, I think that has to be looked at very carefully to ensure that it doesn't fall within the ambit of tax avoidance. And I've laid out some of the other factors that you would need to take into account. There's a very interesting case, which is I would say the landmark case on tax avoidance in Singapore. And essentially, it involved the round tripping of funds on the same day. And our Court of Appeal held that this was clearly a tax avoidance structure. So I think we have to be very, very careful when we have multiple transactions occurring on the same day that are broken up into different tranches. You need to look at it holistically and what is the overall tax impact. I know you have a lot of questions, which I'll be very happy to take at the Q&A segment. Thank you very much.
All right, thank you, Vigna, for sharing. So we'll now open the floor for Q&A. So please continue posting your questions in the chat, and let me begin with a few if there is none as of now. All right, I'll start. So since Vigna, since you're still fresh, right? You just spoke. So I've got a question. So how actively is IRS invoking the GAAR in practice, and what trends have you seen in recent cases?
Okay, so actually it's quite interesting. The
Oh, I kind of want to know as well.
Yeah, so we've had quite a lot of anti-avoidance cases, but most of them have actually been very domestic in nature, right? So you're looking at
All right.
your, I would say, a lot of the professionals, the doctors who have set up multiple companies in order
All
to
right.
take,
We have the same issue in Malaysia as well.
yeah. So for those cases, right, it's, you've tens and tens, maybe even hundreds of those cases. But for international large MNCs, I would say very rare. Yeah,
Okay.
there are probably I've advised on, I would say, a very small handful, and most of them get resolved because the taxpayer does not want to be seen, even though eventually they may win the case, but the fact that a case is being brought against them for tax avoidance, that alone, right, causes them to take a second look and try and reach a amicable resolution. So for large MNCs, international tax issues for anti-avoidance, not very common.
All right. What about if there's any schemes or arrangements that IRS has flagged as being maybe as taking it as an aggressive tax avoidance planning? Is there any scheme that businesses are taking right now?
Yes, so I think anything which, again, I've highlighted some of the examples. If there are circuitous transfers, round tripping of funds, um, and I think anything which is not proportionate to and not commercial, that could be challenged.
All right. So generally it's those still. All right. Okay. Thank you so much. Okay, so my next question is for Mr. Justin. What are the enforcement trends, right? The emerging enforcement trends you see in China's tax environment involving tax avoidance?
Sorry, my line is bad. Can you repeat it?
All right. So what are the enforcement trends?
Hello?
Can you hear me?
Hello?
Yeah, hello? All right, I'll take it with
Okay.
can you hear me? Okay, I'll direct
Yeah,
the
it's okay now.
All right. Okay. Do you get my question?
No, I didn't hear it.
All right. So what are the enforcement trends you see Chinese the Chinese revenue what do you see basically surrounding anti-avoidance with the China revenue?
Actually, especially in recent years, the economy in China is changing, and the tax revenue in China, fiscal revenue in China is going down. So our investors here in China, and as well as the domestic companies in China, are facing very, very strict tax environments, very negative tax environment here in China. Some of the foreign invested companies in China, they are not forced, but they are invited by the tax authority to come to their office to discuss about their tax status and something in China. Majorly, they start the topic from TP issues. Maybe your TP arrangement is okay, but they always start the topic from TP issues. And then in this situation, you just explain that our TP is okay, everything is okay. Then they will shift the topic to your domestic tax issues. And it's quite interesting. I don't know if you know the things in China. For example, in China, if the tax authority believes that you have some tax problems, they will not come to your company to have the tax audit directly, but they will talk to you, say that I saw some strange data or some strange indexes that in your data, and can you check yourself about these tax issues? And when you get this notice, in most cases, you should pay some tax, no matter how big or how small, but not a direct tax audit. If the tax authority sent you a very formal tax audit notice, that's quite severe. It's quite very, how to say, that will be a very negative thing, and you will be imposed a very big tax. So come back to your question. Nowadays in China, in the tax environment is quite, I'd like to say, negative or something. So you should be very careful. But on the other hand, the Chinese government is encouraging foreign investment in China. So one of the good tool is that you talk to the local government and ask them somehow protect you from this tax thing. So it's quite political, but in China we do business this way. And so for most foreign investors, the government will do something to help you.
I see. All right. So given that, they will come and, discuss with you and all of that. You said earlier that, when you have a tax matter, going to court is not an option, right? So essentially,
Theoretically, yes, but in practice, no.
oh, okay. So essentially, you're asking the decision maker to review their own decision again, right? So what are if you were to advise your client, what are like the percentages, right, in terms of reaching a successful settlement with the revenue in China? I mean, also, asking foreign investors coming investing in China, but not having that, third party to actually weigh and balance, who's right and wrong, because yeah, as I said again, asking the decision maker to review its own decision. The fairness, that part. Yeah, that how would you take that?
It may be strange to you, but I like to say that when we talk to the Chinese tax authority about like a TP issue or the tax issue, we may try to understand their target amount. That's quite strange because the system in China is like this. Every year, the local tax authority will be assigned a tax task of that year. How big an amount you are going to impose in that area. So each year they have this task. So when they come to you for a tax issue, they may already have their how to say target amount. So sometimes our negotiation will be based on the target amount for some negotiation. But from that point on, we'll discuss about the tax regulation. But the start point is to understand how big the amount they are going to have, they are going to take. Then we understand how big the amount we're talking about. So it's quite somehow not so, how to say, not as in many other countries. It's more like a political thing. So each time we are very careful. So that means if they come to you, they already have some target to collect. So our negotiation, our help to our clients is to meet what they are going to take or change their target.
All right. Okay, thank you for sharing, Justin. So let me ask Ellie some questions. Because yeah, she's been silent right there for quite a while. Ellie, so would you like to share, any recent developments or trends in Korea tax market that, multinationals should be aware of?
I think in 2024, the Korean M&A market was pretty slow, especially in the first half of the year. Things did pick up a little bit in the second half, but overall, I think there were definitely fewer deals compared to 2023. This year in 2025, the market is showing sort of signs of improvement, and the broader market is definitely rebounding, and the total M&A deal volume is increasing compared to 2024, especially the first half of 2024. But still, in general, cross-border transactions haven't fully bounced back yet. In my view, the political environment kind of also had a major impact on the tax market in Korea because in December 2024, the previous president declared martial law for a few hours.
Yes.
It only lasted briefly, but it ultimately led to the impeachment of the previous president. So we had an unexpected presidential election in June this year, and President Lee took office. And the new administration kind of already signaled a shift in the fiscal policy. And according to the 2025 tax law amendment proposal, which was released in July earlier this year, so 2 months ago, the new government is proposing to reverse the prior tax cuts by increasing both the corporate income tax rates as well as the securities transaction tax rates. And the new administration has also appointed a new commissioner of the National Tax Service. And because the previous government sort of failed to generate sufficient revenue and ran deficits, we are expecting the new commissioner of the National Tax Service to conduct more tax audits and increase the number of tax audits. So that's something the multinational companies investing in Korea should be aware of as well.
I see. So is there any other major tax law amendments that could impact foreign investors that would like to
So
share?
one key tax law amendment that a lot of foreign multinational companies investing in Korea have been asking about is the introduction of a new enforcement fine. So Korea is one of the countries where the tax authority tends to be quite aggressive, and the NTS conducts regular tax audits on all companies every 4 to 5 years, and the NTS tends to request a very broad range of information and documents when they conduct tax audits. And they often also request information relating to the foreign subsidiaries or foreign parent entities of the Korean entity. And this is kind of the information that corporations sort of want to withhold. And there's often a conflict between the tax authority, potential dispute between the tax authority and the companies regarding the scope of information to be provided to the tax authority. There were administrative penalties for failure to comply with the tax authority's request for information before, but the penalties were somewhat considered to be ineffective because the tax authority was not allowed to impose a penalty on the same item more than once. And even if they did impose a penalty, eventually the taxpayer could appeal the penalty at the court level, and most of the times the penalty, a lot of the times a significant portion of the penalty ended up being cancelled by the court. So in response to that, the Korean government has introduced what's called a enforcement fine, and this can actually be imposed, and it accumulates on a daily basis until the taxpayer actually complies with the tax authorities to submit certain information. And the fine amount is based on the taxpayer's average daily revenue. But because this can actually accumulate on a daily basis until the taxpayer complies, this is something that a lot of multinational companies are interested in. And because it only, I think the new enforcement fine applies from information requests made in relation to tax audits that commenced in September this year. There are still a lot of uncertainties around this, and we'll only find out when it actually comes into effect and the tax authority actually starts to impose this new enforcement fine.
All right, thanks for sharing. I was about to ask, what's the rate of success, or compliance by taxpayers, but if not, it's not been enforced yet. But thanks for sharing. Going back to what you shared earlier, right, on offshore indirect share transfers. I was just wondering, how does Korea approach this compared with China?
So in terms of the offshore indirect transfer.
Share transfer, yeah, correct.
I think so. I'm not really sure how China approaches this issue, but because the Korean tax law doesn't provide any explicit rules regarding offshore share transfers, there are still different views regarding the taxation of offshore share transfers, and there are still a lot of uncertainties. But in practice, I think it's kind of the same as Singapore, as Vikna mentioned. In practice, I think a lot of companies are willing to accept a certain risk because it's not really considered a very high risk, to the extent there are documentation in place to substantiate the valid commercial nature of the transaction. So I think from an advisor's perspective, we often say, so long as it forms part of a valid commercial transaction and project, internal group restructuring, or it's a valid transaction between two independent parties, then and to the extent we can substantiate that through documentation, then we should be able to successfully defend against any potential challenges by the tax authorities.
All right,
And as I presented, the recent administrative court decision actually supports that argument as well.
All right, thanks. There's actually a question for Vigna. From Chong Chua. So question is, which industries are favored in Singapore, enabling tax incentives or investment allowances?
Sure. Thank you for that question, Jitshwa. So specifically for refundable investment credits, they have to be in line with Singapore's, I would say, priority economic growth areas, such as advanced manufacturing, international trade, supply chain management, mobility, digitalization and artificial intelligence, and green economy. Thank you.
All right, thanks. Okay, so I have a question to ask you, Vigna. So with Pillar 2 coming into effect, how do you actually see Singapore adapting its tax incentive regimes to remain competitive? No, because I'm from Malaysia, so I want to know what's Singapore doing.
Yeah. So actually, I spoke about refundable investment credits. So I think that essentially.
So basically, it's just credits. That's all that you guys give cash in return. Something that Malaysia could not do, I think, because it's too expensive. Yeah.
Yeah. So in order to fall within the ambit of qualifying credits, they have to be refundable in cash. So you're right? In a way, it's it benefits economies which are able to pay it out.
To pay out, correct.
But that was, I think, probably the easiest way to be BEPS compliant and yet still provide incentives.
I totally agree. Yeah, countries like us, we just can't afford yet as of now, to go to that. All right. Okay, so I have a question for Mr. Justin now. So you were telling us about that, the strict foreign exchange controls. So how do China's strict foreign exchange controls and the limited convertibility of renminbi actually gives rise to tax issues for businesses engaged in cross-border transactions?
Okay. If you want to look at these things, foreign exchange in China, then basically means you cannot convert the currency very freely.
Yeah.
But that means everything you want to convert the currency, you should go through the bank, and then the bank will submit applications to get approval from the Foreign Exchange Control Bureau. Okay. In China, the foreign exchange conversion can be divided into two things. The first kind is the investment. The second kind is the trading and other payments. So the first thing, the investment in China, okay, it's complicated. It can be not mixed with other payments or foreign exchange. You should have a special account in China, and it's called capital account. And you inject money from foreign country to that account, and then you report the use of the money, and then you can convert them into RMB. But for daily payments and trading, service fee, royalty, these things, you just report. For the daily trading, you just report to the Chinese customers. And with the reporting to the Chinese customers, you should pay or receive the foreign exchange. It's okay. It's the easiest one. For other payments, non-trading payments like royalty, service fee, these things, you should first lodge the contract with the tax authority, and then you report the invoices and the contract with the bank, and the bank will report them to the Foreign Exchange Control Bureau. And then you get approval, you can pay or receive all the things. So it's more like a procedural things, not really restriction or something, but you should go through all these procedures. Otherwise, you cannot pay or use the foreign exchange. Then that means you need a lot of administrative things in China for foreign exchange things. But don't be worried about that. You can use and pay foreign exchange.
All right, thank you. Thank you for sharing. So I have a few questions that were sent to me by the participants. So I'll just open these questions to any of you who wants to answer. We have a question here that asks, what are the most pressing tax challenges that that multinational companies face today in cross-border transactions?
I'm
Any-
happy to start this
Sure.
off, and I think Ali and Justin can chime in. So for what I observe is for MNCs, it's about certainty. They want certainty, and therefore I think any sort of ambiguity, especially in transfer pricing, because as you know, when you do the transfer pricing documents, there's always a range. You can always argue where the range is appropriate. So I think certainty is key, which is why we're finding APAs being negotiated a lot more.
All right. Okay, thanks. All right, so let me just also open this question to the floor. Do you foresee greater tax harmonization in Asia, or will the countries continue to compete by differentiating their tax regimes? Anyone wants to take this?
From my parts, I can foresee in coming decades, China is still special in that region. But for TP and the cross-border and the double tax treaties, China will definitely cooperate with all the countries all over the world, especially for the neighboring countries, for all the Asian countries. So when we talk about TP issues, double tax treaties, all the things, I think China will be in future more, how to say, it could be closer to the neighboring countries, have this harmonization. But for local domestic tax things, China will still be unique. I like to say so.
All right, so China stays unique. All right. What about Ellie? What are your thoughts?
Well, I think each country kind of uses tax policy as a tool to shape its economy and attract investment. So maybe the global initiatives like the OECD rules, transfer pricing guidelines, they do create baseline standards, but I don't think it will create full uniformity across all countries, but definitely baseline standards.
Yeah, different countries, different needs, different economy standards, so that's why. All right, so there's a question for Vigna here. What practical issues are companies facing with withholding tax in Singapore, especially for cross-border transactions?
So I think I think that's from Yenling. Thank you, Yenling, for that question. I've been involved in a couple of actually disputes, right, where the issue is whether or not the payment made cross-border is in relation to an embedded royalty. And if it is, then of course it's withholding tax. And of course, the taxpayer, on the other hand, says it's not in relation to any royalty payment, but a payment for service. So I think disputes in relation to what the actual payment is for and whether it attracts withholding tax is what I've been seeing.
All right, thank you. Okay, so we've got a few more questions actually posted. I think this is quite I'll take this question. So this person asked, what arrangement is suggested if the AE goes into insolvency while the counterparty has a receivable? So this essentially means, what if the associate enterprise goes into insolvency while still owing another party? Vigna, maybe you want to take this?
Sorry, the question is what if
The question, word for word, would be, what arrangement is suggested if the associate enterprise goes into insolvency while the counterparty has a receivable?
I'm not
Okay,
sure
so
whether
if I understand the question correctly, they are saying if an associate enterprise goes into insolvency but is in debt, all right, is in debt with a related party, what can that related party do? I'm thinking bad debts right here.
Yeah, so from a tax perspective, of course,
Yeah.
um, the any interest that is owing, all right, you look at not just whether it's paid, it's on a from a Singapore perspective, it's an accrual basis. So any sort of interest which has accrued is still I would say due, and if especially if it's cross border, then there would be withholding tax imposed on the interest that has accrued, even if it hasn't been paid. Yeah, I think I would say that's probably one of the main issues. Of course, the other issue is in relation to factoring sort of agreements, whether or not there's in the event of a restructuring, we often get roped into advice on whether or not that sort of sale of receivable amounts to a true sale, or if it doesn't, because if it doesn't, then there's still withholding tax obligations that may come into play. Thank you.
All right, thank you, Vigna. There's a question for you, Justin, right here. For a few years now, there's a flow of private investors and business investments into country such as Malaysia, Singapore, Indonesia, etc., and into various industries. Appreciate your opinion on the main reason for this. Is this possibly due to encouragement by leadership, government, or was it purely driven by market forces? By market forces of a saturated market, which is China.
You mean Chinese companies investment to overseas, especially to the Southeast Asia countries, the trend?
I suggest so. Yeah, I suppose so. Yes, correct. The
Okay.
question is by Chinese private investors. It's in the chat box.
Yeah. Okay. I think the understanding is right that both sides, like the government and the local business drivers, are also important. First, from the Chinese government, the government encourages all the Chinese business to go abroad. So in China, we have a special policy called "Go Abroad." That means encouraging Chinese companies to investment all over the world. That's also the reason why 10 years ago I was seconded from China to Europe to help the Chinese company to invest in those areas. So this is from the Chinese side, from the government side. But secondly, for the local business of the private companies, especially for them, nowadays the labor cost and other costs in China are very high, especially in some big cities like Shanghai, Beijing, Guangzhou, those cities. The expenses and the costs are very high. So those Chinese companies are trying to find a place with lower cost and the easier transaction with foreign countries. That's the reason why the Chinese companies, including those foreign invested Chinese companies, are shifting their plans, their business, their operation from China to like Vietnam, Malaysia, Indonesia, these places. This is not government driven. It's more like local business situation. So I think both, it's mixed.
All right, thank you. There's a question for Vigna here. I think this would be the final question that we will take before we end today. So between APA and MAP, how should a taxpayer decide which is more appropriate? Are they fundamentally different in scope or just variations of the same mechanisms?
Okay, thank you for that question. So it's actually different in the sense that if you advanced pricing agreement takes place when you have cross-border transactions and you think that there's going to be transfer pricing uncertainty, so you get the tax authorities to come together and you essentially determine what both tax authorities will agree in terms of the prices to be set. Mutual agreement process comes about when there's actually a tax dispute, right? And essentially, there could be disputes, for example, in Singapore over a particular characterization of expense. But for example, in another jurisdiction, like say China, the Chinese authorities under the DTA could take a different interpretation of the same line item. So the mutual agreement process enables the two tax authorities to come together to seek resolution on the matter. So they're slightly different.
All right, thank you. Ellie, any last words? Justin, Vigna, any last words from you all like to share to the participants today before we end?
Okay.
Nothing
Sure.
further for me.
Nothing further on my end too. It was a pleasure. Thank you.
All right, so thank you all for attending our webinar today, and thank you for supporting us as well. If you would like, to reach out to our panelists here from Singapore, Korea, and also China, you could just totally email them directly. I'm sure, right? They can email you if you can email them if you want more info, or if you need more info on the tax matters on this respective jurisdiction. So yeah, thank you, and I hope to see you guys again soon.
Thank you.
Thank you.
Thank you.
Thank you. Thank you so much.